What's up, everyone? It's Karthik with MoneyVest. So markets positioning getting very, very defensive right now as a lot of sectors other than technology are pushing higher and doing well. And there was also a warning from billionaire investor Mark Mobius talking about how investors need to be very cautious and also have 20% cash right now for buying opportunities because this one indicator or essentially this metric hasn't happened in over 90 years. And it is about to take down the market. So as always, if you enjoyed this video, find it helpful, make sure that you drop a like, subscribe to the channel. Also share this video with your friends and family, other investors, traders that can benefit from the message, from the value, and from the helpful information in this video. I would really appreciate that. So this right here, investors need to be cautious on stocks because the economy is flashing a warning sign not seen in nearly a century. This is from billionaire investor Mark Mobius, again calling for investors to be alert as a troubling signal flashes in the economy, and that is the M2 money supply. So money supply surged during the pandemic, as we already know, with a lot of money printing happening in the US with the Federal Reserve and the central bank, but has contracted the most in the past few years, with the total M2 now at 3% lower from its peak several years ago. And that's the largest drawdown, according to this investor, that the total money supply has seen in nearly a century, so in over 90 years. So this decline is historically significant because of M2 that has not seen such a drop in over 90 years. And the main concern is that if M2 money supply has declined since April of 2022 and hasn't kept pace with economic growth, there could be less capital available for the discretionary spending that has driven the current economic expansion and the bull market on Wall Street. Other forecasters have flagged the contraction in the money supply as a potential sign of economic slowdown, and the M2 money supply has only contracted 4 times in total over the past century and was followed by a recession in each instance. So this is another indicator in the favor of a potential recession in the US, because every single time, this is a 100% indicator that it's only contracted 4 times in the past century, almost 100 years, and there's been a recession every single time. And we're starting to see that play out right now. As you can see over here, this is the contraction that they're talking about, with the money supply dropping from its high of 21.7 trillion down to now at just a little bit over $21 trillion. And that's a 3% drawdown from its peak, from its all-time highs from back in 2022. That's March 2022. That pretty much marked the peak for this particular index. And it's also very much correlated with how the S&P 500 has done. So as money supply has continued to go higher, we have seen the markets also push higher, but of course that's put a lot of pressure on inflation as well. So this is something to keep in mind. And again, we know the Federal Reserve is on its path to potentially lowering interest rates, which is only going to increase that more spending, investing, and earnings in general. But at the same time, a lot of the discretionary spending has been driven by credit cards and a lot of debt, as we already know, because delinquency rates are higher or going higher for a reason, because as you know, credit card debt's approaching I think it's already over $1 trillion, and mortgage debt, auto loans, everything has just ballooned ever since the pandemic because of lower interest rates and a lot of borrowing from the users from the people over in the US. And the trend has coincided with a number of other warnings over the strength of the economy. The job market has slowed steadily over the last year, with unemployment recently spiking to its highest level since the pandemic. And some sectors like housing and manufacturing are already seeing a slowdown as high as interest rates weigh on the activity. In the meantime, investors should be waiting for buying opportunities in the market and doing their research on companies with strong financials, is what he mentioned. This right here is the AI sentiment, so AI investor sentiment. And where do they think the stock market will be in 6 months? The week ending in 8/21, 56% people are bullish. We've got 8/14, 42% of people were bullish. But if you come down to 7/31, we had again majority 45% were expecting for the markets to be higher in 6 months, and yet we did also witness almost a 10% correction in the S&P 500. So 1-year bearish high happened back in November of 2023, and then 1-year bullish high happened in December of 2023 for this sentiment survey. Now, coming over to how we're doing on the day. So if you take a look at the markets right now, we've got the S&P 500 down about 11 basis points, so not a significant sell-off, but we did witness quite a decent sell-off intraday. We were down almost 70 basis points here intraday at one point, and of course the Nasdaq was also selling off a little bit over 1.5% at one point during the day. And I hate to break it to you, but technology is lagging. I mean, Tesla is down a little bit over 3%, AMD is down over 2.7%, Nvidia is down almost 2%. The entire Magnificent 7 index is down over 1%, with semis down a little bit over 2.3%, with only Google and Netflix are higher, but just about barely. And if I show you actually what is going up on the day, right? So again, compare this with other parts of the market. I think it's really important for us to understand where the liquidity is going to, and this is a clear-cut sign. And market, again, don't forget, the markets are very, very forward-looking. So I really want you to take a step back and understand the markets are forward-looking. They anticipate what is going to happen in the future, and that's why how the markets change, how investors become more risk-averse versus defensive versus bullish versus aggressive in terms of risk. A lot of those decisions get filtered out by where money is going, where liquidity is going, where the capital is going. If you figure that out, I think that's the most important thing. And we talked about how S&P 500, of course, having a little bit of a double top. With today being slightly down, we're starting to consolidate sideways. I think there is a lot of resistance, a lot of supply that the bears are keeping us below. So there's that. But then really want to touch base on stocks like or sectors like XLP. I mean, take a look at this. Take a look at this green candle. 85 basis points, right? 85 basis points higher for consumer staples. Just take a look at this. And this is the shift the markets are experiencing right now. And it's kind of interesting because if you go back to, let's say, August 5th, this particular index did not even sell off. It did not even pull back. I mean, investors are already rotating into staples for a really long time. As you can see that it was basically trading sideways. And then it's, of course, exploded to a new all-time high at over $82.55. You want another one? Take a look at utilities. XLU. On the day, this sector is also green, up over 68 basis points and just been on a consistent rally higher. So this right here has been the entire rip on utilities, and we've seen a gain from its July 2024 up a little bit over 12.6%, not to mention a nice yield of almost 3%. So, and then finally, if you come over to XLF, which is another sector that is higher on the day, up over 0.5%, and from its lows of back in August 5th, it is up a nice 10%, traded back up to all-time highs. So if I put down all of these sectors, right, and if you compare this to XLK, you got a very clear answer here. We're not near all-time highs. We are higher from its Monday's lows. We're up over 18%, but we're consolidating sideways and we're nowhere near back to all-time highs. If anything, we're seeing a lot of weakness on the day today. It's down a little bit over 1%. So if I were to simply create a watch list, right, and show you 4 different sectors, maybe I do have that. If I don't, I should create a new watch list that shows you all the different sectors that are in the S&P 500, right? You'll very quickly understand this is a defensive positioning from the market. Is TLT higher today? Slightly lower, 11 basis points, so coming back up to that resistance. So there seems to be a little bit of a flat day for NASDAQ, for S&P 500, of course, for the bond market, but there is money rotating into other parts of the market. And that's why we've seen a little bit of that strengthening of the rally, and an S&P 500 not up on the day is exactly the reason why Magnificent 7 it needs to lead in order for the markets to be higher. In other words, if Magnificent 7 does not lead the market rarely goes anywhere because the other parts of the market are not strong enough to pull their weight, because 37%, 34, 35% of the market is a Magnificent 7. So I'm actually working on another new spreadsheet, which is going to track the technicals for a lot of different metrics and a lot of different indicators like S&P 500, Russell 2000, Dow Jones. And we're really just going to be tracking where we are with this sort of technical positioning. But I also want to go over to the MoneyVest dashboard here, and I've added a few more things, which is the valuation. We're trading at almost 23 times earnings multiple, 90th percentile, and of course we're down a little bit over 1%. But I've also added the Max 7 concentration, which is now over 31% for the S&P 500. So other sectors are not big enough to pull their weight if Magnificent 7 doesn't go anywhere. So So just because the markets are flat does not mean that other sectors are not going higher, right? People would look at this market right now down 15 basis points, they'd be like, it's nothing, right? It's like you can kind of ignore it, but there is a much bigger story brewing underneath when you kind of peel the layers, understand that technology is underperforming drastically, and you've got other parts of the market being more defensive, like XLU, XLP, staples, utilities, financials. They're the ones that are pushing higher. This is what gets hidden under markets very, very boring sort of 14 basis point decline day, is that money's rotating out of tech into other parts of the market, thereby markets becoming more defensive in anticipation of a potential recession, which for the reasons are now increasing every single day, right? So let me know your thoughts down in the comment section below, and what are you expecting from the economy? Are you expecting a recession or not? And if so, what are some of your reasons that you've laid out? But as always, if you enjoyed this video, found it helpful, make sure that you drop a like and subscribe to the channel. And again, happy investing. I'll see you all in the next video.